Over the past 6 years, the S&P 500 has nearly tripled in value. That's one of the strongest rallies we've seen in decades. And even today, the market is still sitting just inches below all-time highs. But when you step back and look at the real economy, a very different picture starts to emerge. Right now, U.S. consumer sentiment has fallen to some of the lowest levels on record. So on one side, you have a stock market that looks incredibly optimistic. But on the other, you have consumers who have rarely felt this pessimistic about the economy, and that creates a clear tension because either the sentiment data is missing something or the market is getting ahead of reality. Now, a lot of investors look at this and think it's nothing unusual. After all, the stock market isn't the economy, right? However, if we zoom out and look at history, we can see that this has never been the case. In fact, consumer sentiment has often acted as a leading indicator for the market. When confidence is strong, like here in the 1990s and again in the 2010s, it usually sets the stage for multi-year bull markets. But when sentiment starts to turn, the opposite happens. We saw it in 2000 when confidence rolled over well before the dot crash. We saw it again in the years leading up to 2008, where the market ultimately lost 60% of its value, and even during the 2020 recession. And the reason for this is actually quite straightforward. Consumer sentiment is closely tied to how people spend. When people feel uncertain about the economy, they naturally start pulling back, and that has a direct impact on businesses. Less spending means lower revenues, slower earnings growth, and over time, that's what the stock market reflects. So, in many ways, the stock market is still a reflection of the economy. What's different this time, however, is that the weakness in consumer sentiment over the past 3 years hasn't really shown up in corporate earnings, at least not yet. Consumer sentiment has remained depressed since 2022, sitting around 47, and yet, over the same period, S&P 500 earnings have essentially doubled, which is a big part of what's been driving the current bull market. That's very different from what we saw in past cycles. In 2000, 2008, and even 2020, when consumer sentiment turned lower, it eventually translated into weaker earnings as well. Now, many investors initially expected this to be the year when corporate earnings finally catch down to weak consumer sentiment, especially with ongoing geopolitical tensions in the Middle East. And on the surface, that argument makes sense. These tensions have pushed oil prices to the highest level in years. And when oil rises, it tends to feed directly into inflation. In fact, inflation has already started to tick higher again, moving above 3% in recent months. And if energy prices stay elevated, that pressure could continue to build. Higher inflation puts more strain on consumers' purchasing power, which is already under pressure. And in theory, that should start to weigh on corporate earnings as well. However, despite rising tensions and higher inflation pressures, earnings expectations haven't really come down. In fact, analysts, including those at J.P. Morgan, are still expecting S&P 500 earnings to grow by around 16% this year, which is a very strong number, especially given the environment we're in. And one possible explanation can be seen in this chart. It shows the weight of the top 10 companies in the S&P 500. And today, those companies alone make up roughly 40% of the entire index. That's nearly double what it was back in 2020. In fact, the level of concentration is higher than anything we've seen in the past 50 years. But here's the part many investors tend to overlook. This concentration isn't just showing up in prices, it's also reflected in earnings. In other words, a large portion of the market's profits is now coming from just a handful of companies. These are giant tech companies like Nvidia, Microsoft, Alphabet, Meta, Amazon, and Taiwan Semiconductors. And their earnings aren't really driven by everyday consumer spending. They're driven by something else entirely: AI investment and data center expansion. So, in many ways, we're looking at two different economies. There's the real economy, which is slowing, and then there's the AI-driven economy, which is still accelerating. And because of the concentration, the S&P 500 is heavily tied to that second one. While consumer sentiment is reflecting the first, and neither one is wrong, they're just measuring two very different realities. And in theory, the stock market can continue moving higher as long as this AI-driven economy keeps delivering. And right now, that still seems to be the case. These large tech companies, often called hyperscalers, are expected to spend close to $700 billion this year on AI infrastructure alone, and it's projected to keep growing well into the next few years, potentially reaching $800 billion by 2028. But this kind of setup also comes with risks, because when a market becomes dependent on a small group of companies, it also becomes more fragile. And if something changes, like if CapEx commitments start being revised lower or changes in regulations, The impact can ripple much more quickly through the broader market and even the economy, and that's why risk management still matters in any market environment. At Capital.com, we'll continue tracking the data-shaping markets from consumer trends to corporate earnings and beyond. Hit like and subscribe to stay tuned.